Good afternoon, guys, and welcome to the podcast. I'm really delighted about today's guest, Alex Langan. He's from Pennsylvania, and he is a financial advisor. He's a wealth advisor. We're going to talk all around investments, 401ks. His big thing is he is an advocate for the average investor to avoid from getting ripped off by these funds and these companies and institutions. So we'll talk about that, and we'll talk about how mainstream is outsmarting Wall Street. And I'm really happy to have him on. Alex, welcome.
Yeah, thanks for having me. I'm really excited to be here.
Yeah, and briefly, because most advisors that come on, they pitch, they put all these funds in it, but you take a different approach. So talk about how you approach investing and how you help serve your clients.
Absolutely. So before I became an advisor, which I'm part of a family office, my father started this 40 years ago, but previous to that, I'm still a licensed attorney. I've seen people consistently and continuously be ripped off, but it takes a decade. I clerked for the Supreme Court of Pennsylvania. So it took a decade for us to see it and try to help people. I ultimately still retain my license, as I mentioned, but now I'm able to help people proactively up front to avoid the pitfalls and mistakes of getting ripped off potentially by a system that's been built to maximize profits for Wall Street, not for Main Street.
Yeah. And so talk about, you have actually a different approach. So which clients come to you that are seeking? Is it the average mom and pop? Is it high net worth? Who do you help serve?
It's usually high net worth. It's business owners, because my background, I'm also an adjunct professor of law, ERISA law as well, but I help business entity structures. So complicated business owners, high net individuals, and also executives that may have some type of stock options or something like that.
Yeah. And so the other thing is, one thing that a lot of audience and people listening to this is, how do advisors get compensated? Is it a flat upfront fee? Is it a percentage? Conflicts of interest? Talk about that.
It's fascinating. Each advisor is different. So you need to know what business model they're set up as, and there's fee only, fee based, and then there's everything in between because people say different things. And so I get compensated typically based off the assets, not fee only, because I do believe people need some life insurance or something, especially business owners have a larger liquid asset. But the way I see people be misinformed is the word fiduciary gets thrown around so often that it's meaningless almost. And it's the second worst F word you can hear is fiduciary. But to that extent, we are fiduciaries. And what that really means is, at the end of it, is that I'm legally obligated to put your interest above mine. So you need to see it in writing that somebody is a fiduciary. Otherwise, they say it and it's meaningless.
The next question I have for you is, we were talking about there was a recent article I read where Main Street, I think it was Forbes, but I can check it out, is that retail investor is actually getting smarter with tools such as Robinhood and AI. And you mentioned Polymarket in the pre-show. So how can people protect themselves from getting ripped off? There's still like doctors that still invest in mutual funds, which is a horrible investment. We're talking about 3% returns. So how do you help those people?
That's fascinating. And honestly, mutual funds are usually the only thing you can invest in a 401k. Usually some ETFs are getting in there, but I love that. I love the fact that retail investors are now starting to be able to actually get half decent returns. So what I mentioned before was that all the information I've seen is that the average retailer a retailer on average makes 3% in the market on average across the board, when the S&P 500's 8 to 10%, whether or not you're taking dividends into account. The fact they're getting better is amazing. They're getting more educated, but with the more information coming your way, that includes misinformation. So you have to be careful about what's good and what's bad. You have to be able to filter it. So if people are able to filter, phenomenal. So how do you avoid getting ripped off? Honestly, you have to be balanced. So you have to be well diversified, unless you ride up Palantir last year and you've made 1,000% returns over a couple of years. And then why would you diversify? At some point, you have to be careful. Individual stocks are great. If you're trading on, I'm not a fan of Robinhood, GameStop, that meme thing that came out. I'm still frustrated that there's been no prosecution or even anybody looking into the allegations that were made against that. So I personally stay clear of that just because of the ethics. But like, you can do Schwab, Fidelity, wherever you can go and you can avoid the commissions. You got to make sure that you're not getting ripped off by whoever's helping you out. And then be careful. Don't use leverage. Don't do the margin. Don't use margin because eventually it's going to bite you. Up markets, everyone seems to make money. Down markets, you just have to run and hide somewhere. And you don't want that margin to exacerbate the potential losses that you could have.
Interesting. That being said, there's all this talk. People are saying like 2026 is going to be a great year. We're going to have Jerome Powell is going to be out in May, and you got midterms. So, Republicans, they want the market to do well. But then you have people like Tom Lee and people going on the CNBC and Bloomberg saying, oh, it's going to be a dip. So how do you see the markets currently?
So the talking heads on TV, be careful. They're pushing their agenda. They're pushing their book. So just be careful with that. But overall expectations are high single digit to low double digit returns for the market. I think for at least the first couple of quarters, we should have some good GDP returns. What keeps me up at night is that federal deficit. It's a ticking time clock, ticking bomb for when does this blow up? We're kicking the can down the road by increasing GDP, lowering rates so that payments won't be as much when we're refinancing, which we're refinancing Troids at this point. So that's what I would keep an eye on. I believe this year will be good, positive, obviously up and downs. Last year was a good year, but as you guys, hopefully mostly people recall, April 9th, we just touched 20% and then came back from there for the year. So depending on when you invest, if you're dumping a ton of money in and trying to time the market, you could find yourself in trouble. I always say it's not timing the market, it's time in the market for your returns. So you just want to be careful about it.
Yeah. The other question I have for you is for you help a lot of business owners, 401ks. These are like investment retirement vehicles. They have their pluses and their minus. And so someone who basically understands business and they can generate revenue, they understand finances, they can save on their taxes. Is a 401k still optimal plan if they know how to make significant returns and protect their wealth?
It's a piece of it. They always say the three-leg stool, but for a business owner, you need 6 or 7. No, sorry, I didn't mean to go there with the kids. You need multiple legs. So it's phenomenal, but at the end of the day, you can at most put in 70,000 to that. Maybe you can put in up to a little over 200,000, 250,000 if you get the defined benefit plan and everything together. That will not help somebody that's a very successful business owner. Your biggest asset is your business. So take the valuation of that. What that is a key for your employees. So I actually am having a book published here in 2 months, hopefully, 401k Exposed. It gives a fiduciary formula for how to run your 401k plan, group retirement plan in general. That you really are taking care of your employees. It's a benefit, just like health insurance. You can maximize it by watching the fees, protect yourself, having what I call as a fiduciary formula to make sure if you do get audited, which the chance is less than 1%, unlikely, unless you get a frustrated employee that knows what attorney to talk to find where the skeletons are hidden. But you can set it up to have some really nice returns. You can have a couple of million. If you start young enough, you can have 4 million or so in there at the end with the right bull markets. But if you combine that, hopefully Social Security, which will be bankrupt in 6 years. But if you still have that around and then some outside assets, you can have a nice lifestyle to continue. The key there, though, is it's rare that the 401k, if you live a high lifestyle and you're comfortable and that's what you're going to continue in retirement, it could be challenged to save enough inside that 401k in and of itself, even with exponential gains to be able to live off retirement. Plus, you're going to get crushed in taxes with Medicare surcharges and everything too, if you're pulling a couple $100,000 out of that a year.
Interesting. We do have a question from the audience. And one thing is, for example, if they're centimillionaires or billionaires, do they still use this 401k strategy, or is it?
Absolutely. Yeah. Why would you do that? The problem with that, with doing a 401k, that's purely for your employees. To be able to save $70,000 when you're worth even $50 million, nah, I'm good. Yeah. It's not worth it. And you have to do safe harbor matching, so 3 to 4% depending for your employees too, just so that way you don't have to pull your money out as being top heavy, depending what industry you're in. The answer is no. Yeah. Long story short, no, they do not. They don't care about this.
Yeah.
Why would they? Yeah. They're doing private investing, private markets, private placements, buying businesses, venture capitalism, that sort of stuff at that level.
Yeah. And the next question is, because you mentioned the government debt and also military spending, and this seems to be the entire motive of the U.S. government.
Okay.
So how does one, like what vehicles? Is it gold, silver? Is it Bitcoin? How does one protect against this type of the way, the direction the country is headed?
Yeah, exactly. Somewhere where you can store your value. So that's great. Bitcoin's yet to be proven. I've been a part of and helped created Bitcoin cryptocurrency symposiums. So I wouldn't say I'm a hardcore believer. So far it's worked out. But as long as it continues for the trajectory, whether it's internet usage or whatever it is, networking effects, it should continue to be positive. But at the end of the day, gold, silver obviously has played out really well. You can also look at other types of commodities, whether it's copper has been heavily talked about right now too. Not that this is investment advice, but copper has been heavily talked about because it's heavily needed and crucial for the AI build out. So they figure that could help alleviate some of the strain or correlation to equities and fixed income, especially what we've seen like in 2022 when everything was correlated. So we are doing that for our clients, looking at other opportunities like that. Yeah, that's good insight from whoever raised that question.
Yeah. The other question is, because we were talking about gold. Silver is almost at the all-time high. Do you believe it's a bubble, or is it still continue, or should we be cautious?
So this all comes back to the federal deficit. If we get the federal deficit under control, yeah, it could easily be a bubble. That and gold, it touched above $80, which is insane. And then it obviously came back down. If the federal deficit continues to climb, it's probably not a bubble. If we get the federal deficit under control, then it very well could be a bubble. But the question is to whoever asked that, do you think we are capable of getting the federal deficit under control?
Yeah. And so talk about how you get a lot of questions around holding cryptocurrency or Bitcoin, Ethereum in 401ks. So is that going to play out, or is it something just the government is against?
So it's fascinating so the government actually has come out and hasn't really held anything. Fidelity was allowing people to put crypto in. The easiest way, especially if you're a doctor or whoever, would be open up a brokerage account inside your 401k, and then you can do whatever you want in that. If you're the owner of the business and you open up a brokerage account, be very cautious, because any one of your employees is allowed to do the same thing. They can invest in whatever they want outside of it. There's really no way for you to monitor what they're investing in. And if they lose all their money, they can come back to you and say, it's your fault. You let me do this. It's almost like having a toddler running around the room breaking stuff, saying it's your fault. So the answer is yes, you can do it as long as you get the right vendor that allows it. As if you're a fiduciary, I would say pump your brakes and think twice before allowing other people to do it. I think there's other more proper vehicles that you can do it. You can even go and so that's all an ETF, just tracks it. You can actually do it. You can take your money and do a self-custody IRA, roll it over if you allow in-service distributions, roll it over and that physically buy the Bitcoin. So that way you hold it and you're not just tracking an ETF. Other options.
Interesting. So talk about what's the latest federal regulations impacting group retirement plans.
Cool. Security 2.0 is the biggest one. I'm actually having an argument right now with an auditor about it. They just don't feel like applying the new updated regulations, which is not an option. But for this auditor, it is. Anyways, I'm still bitter because I just had to write the legal rebuttal for it. But so there's so much going on. The biggest thing this year, which I hope everyone's already fixed, you have to allow Roth contributions into your 401k plan this year if you have not. Also, the reason would be for that is catch-up contributions and what's known as super catch-up contributions allow you to put a little over 4,000 more than the catch-up. They have to be Roth contributions now. There's different ways to account for it, but you have to allow Roth contributions. And if you're one of those individuals making Roth contributions that has to make Roth contributions as the catch-up, just realize you're going to pay a couple $1,000s more in taxes that you probably haven't adjusted or accounted for. So just be aware of that. You're going to be upset next year if you're like, why do I owe $2,000 in taxes? Not realizing that it got funneled in as a Roth instead of the traditional pre-tax that you're used to.
The next question from the audience is, how does the big, beautiful bill impact 401ks?
It actually doesn't touch upon it in and of itself. The Secure 2.0 and the ancillary regulations were the ones that really focused on that. The only way it touches upon it, well, people are probably going to want to gain access to it to try to flip houses or do the Airbnb stuff. I don't know if you guys have touched upon. That's probably how, like, I need access to capital. I can grab it from there. Just be careful with taking loans and stuff from it. But technically or legally speaking, it doesn't directly coincide with 401ks.
So rapid fire, we actually have someone in med school talking. He says, what are the top mistakes people make when planning for retirement?
Not saving early enough is the biggest one, especially being in med school. You're inundated with bills. If you're focused on that, you're going to miss out on the power compound interest. So I would highly encourage you to try to at least save as much as possible initially. You also have some pretty cool opportunities where you're going to be able to negotiate. Be careful where you go. This is completely outside of 401ks, but just be careful where you're going and who you're contracting with. The power is with you for this. Regarding investing, I would highly encourage you to be careful taking on debt. You've worked your butt off. Hopefully you don't feel as entitled as most lawyers feel, that they now should spend anything and everything they could even make on the next couple of decades. So try to live under your means or within your means and save for retirement now. It makes it a lot easier later on when you're really crushing it. You paid off your debt. You won't have to save above and beyond what you really should for retirement and starting in your 50s if you started when you're 30 or whatever.
Then on the opposite end, we have actually a doctor listening, and she's in her early 50s, and she says that her 401k, the hospital only allows certain funds. Yeah. And we were talking about like people getting ripped off, and is it limiting access? Is that so that they can maximize their fees? Like, why can't people go and buy stocks or not advocating, but options or crypto?
Yeah, it's to protect themselves, their fiduciary liability. They have to have a set investment fund lineup. Now, the cheat code, and I go into detail with this in my book, but the cheat code for that is look at what the share classes are. R6 for institutional in the name of the funds mean that they're the cheapest possible, normally the cheapest possible. If they're R1 or any other derivative through R5, that means there's some hidden revenue going on there. So be careful with that. Sometimes they structure it so you can actually get a free lunch if you look at all the other internal investment expenses. And I highly try to discourage this when people set it up, but you can take advantage of it yourself with the passive investments. Sometimes they don't have revenue sharing underneath, so you may be able to get cheaper than compared to everyone else. The reason why they do it is protect themselves from liability, protect you from doing like a triple leverage Bitcoin ETF or whatever. And then the next is just also they may do some hidden revenue sharing, which I absolutely despise. I go on and on about it. I can give example after example, but you got to be careful because that is how the providers get rich off of it and not even have to disclose it or tell you about it. So you got to be careful, but those are the reasons.
Well, we actually have a very interesting question because you mentioned gold, silver, copper, and this individual is asking, where does palladium, platinum, and rhodium fit on the risk spectrum compared to gold, silver, and copper?
Great questions. I have friends that made a lot of money off of that stuff. But so generally speaking, all the same category commodities. Obviously, their uses are vastly different. Gold and silver are the only ones that are really pictured as this pure store of value play. So people see that as storing money, whereas the other ones they all have uses, but those seem to be the most common. And obviously gold and to some extent silver are the ones that are being bought up increasingly by countries, international companies or countries. The entities that want to purchase them are much larger. Demand's higher is really what the big difference would be for that stuff.
And then she asks a follow-up question for example, because I think Trump, he signed bills promoting nuclear energy. So is nuclear energy stocks, are those speculative or are those that's the direction that the energy industry is going towards?
Yes. Both of them. Absolutely. Yes. Like the one doesn't have any production in place and they've gone from like $3. I saw one up to $16 or $20 and they aren't producing anything. So yeah, it all sounds great, but until in your backyard, you have a mini nuclear reactor producing energy, I would say hold off on all the pie in the sky stuff. And I live a couple miles from 3 Mile Island. So Microsoft just bought it and their Constellation Energy is getting it back up and running for them. So it is absolutely coming. Nuclear energy is very big, but you just be careful. Actually, the stocks are getting beat up today too. Constellation Energy is getting beat up. They all are. Keep an eye on the price to earnings, in the forward price to earnings. And when they get up to 700 or so, like Palantir is at, I would probably be weary of too many strong purchases.
And the final question, because we know you have the next meeting to go to, is this is a graduating residency doctor, and he doesn't want to work for a hospital, so he can't participate in a 401, but he wants to do like locum and be solopreneur, self-employed. How does he get involved in this 401k?
So he could absolutely crush it. First, you got to get steady cash flow going. So let's assume that you're up and running, you're doing amazing. If you're by yourself, you do what's known as a solo 401k. In that, you can put in 70,000. Be careful putting it into a Roth. There's two different categories of pre-tax Roth. You have two separate accounts. For accounting purposes, you set it up with different EINs because they have to be qualified. But be careful putting it as a Roth. You can put in 24,500 starting this year as a Roth. You do that, you actually lose some of your qualified deductions. So for tax purposes, if you're not making much, cool, do it. If you are starting to make a lot, you can put in, I think it's a little bit over, it's like 71,000, some change now. Total 100% pre-tax. You could also do, and that's counting everything across the board, employee, employer, but it all goes in the same bucket. Your accountant can figure it out later. That's assuming you're not an S Corp. If you're an S Corp, you got to stick to what your W-2 is. So be aware of that. Next, you can do a defined benefit plan if you want to. So you're absolutely crushing it. You can do a defined benefit plan, so you can tie them together. You might have to put a little less in your solo 401k. But your defined benefit plan, you can absolutely rock it. I've seen people put in almost $300,000. I'm not saying to hire your spouse uselessly. Do not do that. But if your spouse gets involved, front office or something, she can be a part of the plan. And then you just essentially can almost double, like they can get to 71,000 and so on and so forth. So it actually makes it more beneficial, and you can set up cheaper than a 401k plan. I've set these things up. There's as cheap as a 50 million asset 401k plan. It actually can be more beneficial for you.
Yeah. Awesome.
Long story short.
Yeah. How can people contact you to get more advice and book a call and connect with you?
Yeah. So you can find me on my website, langanfinancialgroup.com, LANGAN financialgroup.com. My email is alex@langan, LANGAN financial.com. Reach out. I'm around. On the website, you find my email, even cell phone, whatever. Give me a call. I'm around, just Eastern time. Don't call me too late because my kids will be mad.
Excellent. I really enjoyed this format, the rapid fire. And for all of the audience, Alex's links will be in the show notes. And thanks so much for coming on.
Yeah, thanks for having me, Chris. I enjoyed it. And great questions from your audience there.
Yeah.
First.